Joe, the final round of remarks for you, and then we will come to Q&A. Just I remind you, if you have a question, then use the Q&A box at the bottom of your screen. Thank you.
Okay, thank you, Pierre. So I'm at a bit of a disadvantage here because the other speakers have all done a lot of research in this area, and I have not, but I've been a long-standing researcher and practitioner of monetary policy. I'm going to start talking about COVID a little bit, just because I think that was an emphasis that you brought, Pierre. And as both you and Liviu noted, the COVID pandemic has profoundly increased inequality. And to say that in the context of income inequality is almost embarrassing, because COVID is increasing inequality in ways that we aren't measuring at all in economics. Most notably that mortality from COVID is much worse at the lower end of the income distribution. This is a huge, huge problem, which we have to say is number one, but also in education. Whereby it's really hurt the education of low-income families, and that won't show up for a long time in any income inequality data. So it is a huge crisis that has a profound inequality effects. I think in terms of response, policy response, and I'm going to limit myself to the economic policy response. Obviously, health policy is critical, but we're not here to talk about that today. The key point, in my view, is that this isn't the topic today, but it just needs to be said that the key policy obviously needs to be fiscal policy. Only fiscal policy can really transfer the money targeted to where it's needed. People who are hurt, especially at the bottom end of the income distribution, they need transfers. Loans is a distant second best and limited in capacity. Low interest rates that central banks can give is just distant third best. So central banks, yes, they need to set interest rates, policy rates where they need to achieve their mandates, which almost certainly means very low interest rates and lots of purchases of government debt to make it possible for governments to finance these transfers. There's a brief side note, if central banks can do fiscal policy in a few countries, apparently it is legally possible, including the ECB, then they should by all means do fiscal transfers, helicopter money, call it what you will. And in the United States, I know this is actually legally forbidden for the Federal Reserve to make transfers. So this is unfortunate, but the Federal Reserve can help in many ways, but it cannot do fiscal policy in this country. So both Ratna and Liviu talked a little bit about the regulatory relaxation, so getting more to the topic of today's session, that some relaxation of lending standards in the crisis is certainly appropriate. And I would say, given the uncertainty with which so much uncertainty about who's going to be affected and who can they repay, and it would be crazy to clamp down and use normal standards on foreclosing on loans in the midst of a crisis when we really don't know what the world's going to look like coming out, and we have some hope that fiscal policy could help. So absolutely, regulatory forbearance, relaxation, call it what you will, is absolutely critical. But it isn't the first order policy that we need. As I say, I think fiscal is going to be key, and that includes guaranteeing some of these loans, subsidizing some of these loans, making them forgivable, government forgiveness under certain conditions, but that's really fiscal policy. But regulatory policy needs to work hand in hand with that. Just a little brief note on my personal topic, which is quantitative easing. I know it's not today's topic, but just to note that it is true that quantitative easing, which central banks are doing in this context, contributes to wealth inequality. And we've seen the stock market in the US break records, which clearly increases wealth inequality in America, and it's partly due to the quantitative easing, but it's also partly due to the nature of the fiscal response, which wasn't as targeted narrowly as it could have been, and therefore a lot of high-income households who got transfers are saving that money and buying stocks. I think it would be nice to see income inequality studied more in splitting into between labor income and capital income, because I think what you'd find is that QE has very different effects on labor income inequality versus capital income inequality. It does raise wealth inequality, but QE helps labor income at the bottom much more than at the top, overwhelmingly so. And so for low-income households, this effect is just hugely important, as Ben Bernanke has said repeatedly. And as Ratna said in the paper, the background paper, which I read, what we really would like to have is more granular data to understand these links between financial regulation and inclusion and inequality. And one granularity thing I think I would propose to people is really seeing the difference between labor income inequality, and capital income inequality would be useful. In particular, the literature finds really large, impressive correlations in some dimensions between elements of financial regulation, financial stability, financial inclusion, and inequality, really large, which is eye-opening and reflects something really going on. But we have to be careful that we need to understand the transmission mechanism underneath that, because we do risk that there could be third omitted factors there going on that affect both inequality and the financial sector in ways that raise this correlation. And if you don't take awareness of that, your actions on one side of that equation might not have the effect you expect on the other side if you don't know the transmission mechanism. I think that's a key point to keep in mind. I think a big point that I didn't see in this literature or in the discussion today was just a general talk about how financial boom and bust, which is what financial regulation fundamentally is usually aimed at controlling, how financial boom and bust affect inequality. Ratna has some information in her paper that shows that financial booms tend to raise inequality, and they actually lower it in the bust, which would seem to be a good effect. But I think there, the distinction between labor income and capital income would be especially important, because I expect in terms of labor income, it's just the opposite. And that may be what matters more for the low income households. So I think more work there, I think, would be very helpful. I think we know that historically, financial liberalizations have led to this boom bust cycle in many countries around the world. It's a very common pattern. And so understanding the inequality implications of that really need to be, I think, studied more and more granularly, as Ratna indicated. So let me just finally conclude with two specific points, just motivated by today's discussion so far. One is, I think certainly Atif is absolutely right on the saving glut of the rich and how inequality has really driven finance, especially in the US, but I think in other countries too, in the past couple of decades. And I think this is a key point that people need to recognize more. What's less clear to me from this literature, and I didn't hear it today from Atif, is, this seems to me this mainly that inequality is driving the change in finance, not vice versa, but is there some senses in which that's not true? I'd like to hear if Atif thought so. Atif says that macroprudential policy is contractionary, and yes, that's true if you mean that preventing some of these loans from the richest to the less well-off sometimes are excessive, and we saw that in the housing bubble, and if we had clamped down on those no-doc loans and whatever, it would have been contractionary macroeconomically. That's certainly true. It would have lowered our star. But it seems to me that something he didn't stress enough is fiscal redistribution policy ought to then raise our star. It ought to be expansionary, because you're taking income and wealth away from the high savers and giving it to the low savers. And I think that seems to me a very important thing. So if fiscal expansion and more public debt is the answer, as I think it is, and investment programs that help the low income are wonderful, I totally agree, but even just pure redistribution ought to be helpful in this regard, to be expansionary, to raise our star, to make monetary policy more effective. And I'm curious, I think something that Atif had written said that he thought both private and public debts were harmful for lowering our star, but I don't understand why public debts would be. There's a long literature that I've worked on that shows that public debt actually raises our star. And I don't know if that, I don't believe that's changed. And then final point, just briefly on to Liviu, made a brief comment that is off topic here, but I couldn't help but catch on to it. He mentioned that maybe in the COVID crisis, there's less evidence of downward nominal wage rigidity, but I'm surprised. I don't know what's going on in Romania, but in the United States, I would have said exactly the opposite. This COVID crisis has really shown the importance of downward nominal wage rigidity. There's been a collapse of labor, and yet measured wages went up. And of course, that's because the people at the bottom were more likely to lose their jobs. But the key point is that people are not taking pay cuts to save their jobs by any means. In fact, there was quite the opposite. There was a bit of a movement afoot, although it didn't get very far, to actually raise wages in the crisis because of the extra costs it was imposing on people. That didn't get very far, but there certainly was no evidence in the US of anyone taking a lower wage to get more work. I'll stop there. Thank you.